I'm Neil, and I'm the teacher.
And I'm Sean, and I'm the deal maker.
Together,
We're the Rise Guys.
Welcome. If you think your credit score and your income are the key to getting a commercial real estate loan, you are looking at the wrong map entirely. Today, we are going to bust that myth wide open. The biggest mistake people make is thinking that getting a commercial loan works the same way as getting a mortgage on your house. It does not. We are about to show you exactly what banks really care about when millions of dollars are on the line. For a home loan, you know the drill. The bank puts you under a microscope, your credit, your income, how stable your job is. It is a totally personal evaluation. The bank's entire decision hangs on your personal promise to pay them back month after month. You are the financial engine that makes the loan work. But in the commercial world, the bank is not really lending to you. They are lending to the building. Seriously, your personal bank account suddenly takes a backseat to the property's own financial report card. The property itself has to prove it can pay its own mortgage. The building literally becomes the borrower. If a building has to prove it is a good investment, how does it do that? Well, bankers have a very specific playbook. First up is probably the most important number in the life of any investment property, the net operating income, or NOIs. Take all the money coming in from rents, subtract all the bills it takes to run the place, taxes, insurance, maintenance. Whatever is left over, that is the NOI. It is the building's pure raw profit. Next, you have got what the property owes the bank. It is called the annual debt service. It is just the total of all the mortgage payments, principal and interest, over one full year. It is basically the building's single biggest bill. Bank figures out all the income, subtracts all the expenses to find that critical NOI number. Then they compare the property's profit to its mortgage bill. That one comparison gives us the most important metric in this whole process. The debt coverage ratio, or DCR, you take the net operating income and divide it by the annual debt service. If your DCR is less than 1, you are in major trouble. It means the property is not even making enough money to cover its own mortgage payment. What banks want to see is a cushion. A DCR of 1.25 means the property is generating 25% more cash than it needs for the loan. That is the sweet spot. It gives them a nice safety margin in case rents go down or something breaks. For some deals, the bank's role changes. It goes beyond just a simple loan. Sometimes the bank does not just want to be a lender, it wants to be your partner. And the bank will agree to a lower interest rate, but in exchange, they take a small slice of the property's gross revenue. Your annual debt service drops, which makes your DCR look much stronger. Why would you give the bank a piece of your revenue? Because it can be the key that unlocks a deal you could not get otherwise. That lower debt service jacks up your DCR, which might help you qualify for a much bigger loan. You are basically making the deal safer for the bank, and they reward you with better terms and more cash. This is the single most important thing to take away from all of this. When you're looking at a commercial real estate deal, you have to stop thinking like a home buyer and start thinking like a banker. The person signing the documents is almost irrelevant. The real borrower, the one being judged, is the property itself. And when you make that shift, it changes everything. It forces you to look past the fresh paint and really dig into the numbers, the cash flow, the business plan of the building. Now that you can see the world through a banker's eyes, how does that change the way you look at the next big investment opportunity that comes your way? New webinar summary every week. Subscribe so you never miss one.